Hello, buenas tardes a todos. Empezaré en español, luego cambiaré a inglés. Hoy tenemos con nosotros a Perry Kaufman, de todos conocidos. Eh, Quiero agradecerle. I want to just tell you how nice you are for giving us the presentation about diversification, una presentación sobre diversificación, pero dice que no lo va a tratar de la manera usual. Así que nada, aquí tenemos a Perry Kaufman y luego tendréis ocasión de hacerle preguntas. Now is your turn, Perry. At the end, the students can give you questions, can ask you questions,
Yes,
and
we
we are
can.
very pleasure to be with you right now. Your
Okay.
turn,
Well,
whenever you want.
thank you for joining me, whoever you are. And if you're going to watch this by tape, thank you for that too. I'm going to talk about, let's go to diversification. But I hope it may be a boring topic for you, but my approach to diversification is very different from the classic approach of looking for correlations and trying to reduce your risk. I don't think that's a way to be successful in the market. So I'm going to talk a bit differently about diversification. So you'll have to bear with me at the beginning. We'll go through a few standard things. This is a disclaimer that I'm required to put on all presentations. It merely says for the US government that you can't believe anything I say. So we'll go past that. A few things that I think are very important all the time, no matter what presentation I make, is to question everything you see. I'm going to tell you certain things that I believe are true, but you need to test them yourself. So nothing is really true, and you don't actually believe anything until you prove it yourself. Okay, and some people will give you remarkable returns and wonderful systems that are clearly too good to be true. And of course, as you have more experience trading, you'll be able to look past these things. So I want you to verify everything that I say before you actually trade. I also want you to trade, well, something I was just discussing before we started this is I believe that you don't learn enough when you develop a system and then paper trade it. I think it's very, very important to actually put money in the market, a very, very small amount, anything, so that you can experience what a real loss is. I don't think paper trading gives you the idea of how to deal with a loss. And I think dealing with losses is the biggest asset you can have as a trader. It's what you learn over time, is how to take a loss and continue trading and not let it worry you, because in the long run, you'll wind up ahead. And as I say at the bottom, for most of us, trading is a business, not a hobby. So we treat it that way. So let's just start with the idea of what diversification really is. It's not putting all your eggs in one basket, all right? It's what we know of when we deal with correlations. We want things that make money at different times, that have different volatility at different times. We want to find markets that essentially work differently. We also want to find strategies that work differently. I think you'll be probably aware that if you're all in the stock market, there are times when there is no such thing as diversification. The market, you've seen the market recently with the US administration saying in the last day, I'm going to follow I'm going to get rid of Chairman Powell and the market will drop 4 or 5%. And the next day, today, he says that the market will not do that and the market goes up 3%. I think that's not something you can do. It's not something you can get rid of with diversification. You need other methods of risk reduction. And I'll talk about those because I think diversification works in some cases and not in others. I think using different strategies is much better than trading everything on one market, which can have very different, a lot of problems and a lot of volatility. So let's move past, because I think you probably know enough about regular diversification. So a lot of things may appear fundamentally different, but they are the same. And one way of distinguishing how different they are is to run your system through the different markets and then look to see whether the resulting returns are really giving you diversification. I mean, you can do some things like I have a measurement that I consider quite good that I used in my adaptive moving average that will distinguish the noise from one market to another. And it's a pretty good measurement, but that's one way of distinguishing whether or not one market is different from another. But the easiest way is just to run your system through different markets and look at the results and see where the biggest drawdowns were and whether they all come at the same place. So you'll know a system will be good for diversification, or two systems will be good for diversification if the drawdowns don't occur at the same place. So just remember, in a crisis, as I say at the bottom here, in a crisis, all assets move together. You may not have experienced the kind of crisis that I have over time, but when the market drops materially, people have to close out their positions. And in some cases, they have to refinance their positions. And to do that, they liquidate other assets. It could be art, it could be gold bars, it could be anything. But it means that all assets move together, even if they're not, if they're not normally correlated, they will be when the market makes a material drop. So situations like this, you can look at two markets, and here you see on the right, you have the ETF for the NASDAQ Qs, and bottom, of course, you see the SOXX, which is a I don't know, double or triple leveraged semiconductor index. And you see that the peaks and valleys are similar, but the Qs seem to be in a downtrend on the top and an uptrend on the bottom. And of course, you'll find that when you look at this, the correlation is, they may appear to be slightly different, but the correlation is remarkable. I'll show you in a second. So you can't be fooled by a chart, and I can show you charts that look very different, but the correlations are greatly the same. So in this case, for example, the correlation between the Qs and the semiconductors over the last year is 0.88, which is pretty close to identical. And it won't help your trading. if you try to diversify into these two things, even if the charts look quite similar or quite different. Wait just a second here. So my view of diversification is that clearly you gain when you have you have low correlation between stocks. You do gain as you add stocks or as you add systems. But you can see from this chart that once you get past 10, which is my favorite number, I find that the amount of diversification you get reduces considerably. In fact, when I am generating a portfolio for my clients, I consider 10 my basic diversified portfolio. So I find that I can get enough correlation out of diversifying into 10 stocks or into 10 markets in general, compared to even more. I find that diversifying into more is more of a trading problem and very little benefit to the market. And I find that I can do quite well with 10 and get everything I need out of it. So if you choose to do more than that, I think that you're wasting a lot of time. So what do we have with maximum diversification? If you really want maximum diversification, you can look at the efficient frontier and find the spot where you want. What do you get? If you really want good diversification, you might as well trade the index, the S&P, the NASDAQ, gives you wonderful diversification. But if you're in the market to beat the market, to have clients that want more than the S&P, more than NASDAQ, you're going to have less correlation. So this model gives you just what you want. It gives you the efficient frontier. You get lower risk and lower returns. And the key is lower returns. Every time you diversify more, you get lower returns. And I worked for a company that had 25 or 30 different strategies. And I had a very hard time explaining to them that even though strategies reduce your risk, it reduces your return. And nobody wants returns that are not outstanding. I mean, people want your expertise so they can get much higher returns than you see in the S&P with reasonably lower risk. I'm not saying unreasonably lower risk, but reasonably lower risk. So your return ratio, your return versus your risk is much better than the S&P. And the S&P is, if you look at return versus volatility, you get, if you're lucky, you get 0.4. And with a trading system that's really good, you could possibly approach 1. And that means your returns are far better than your risk. Of course, I mean, you can lower the whole thing by having lower returns and very low risk, but I think we're really talking first about returns, that traders want returns that are higher than the S&P and risks that are lower. So that becomes the question, how can you do that? You can't do it, as I said, by trading a very large amount of uncorrelated markets, whether they're uncorrelated in the stock market, whether they're uncorrelated by systems. It's not what you're going to need to be a successful hedge fund manager. You're going to have to take risks. And what you're going to do is you're going to have to trade those markets that are very volatile, that make a lot of money, and you're going to have to figure out how you're going to lower your risk in some other way than being uncorrelated. All right, so that is the biggest game, is how do you lower risk and still outperform the market? By the way, I don't know if I'm reading any of these things on the presentation, but that was my intention, is how do you do these things? So the first thing you need to do is come up with a strategy. Now you can do all of this with trend following. You can have a trend following system that hones in on the best stocks or the best futures markets and still reduce risk. So we have trend following. I mean, these would be the basic areas of trading. Intraday trading, you could do. Pairs trading, I like pairs trading. You could trade interest rates. You could have arbitrage. They're all good methods, but they don't really attack the problem of risk. Any one of these can have gigantic risk. So the idea is how do you make money from these systems and create risk and reduce risk? Sorry about that. So my approach, which works for virtually every system, is to do it all in portfolio selection. All right, so the first thing I'm going to do is I'm going to find the stocks and the markets that are going to make the most money. I'm going to concentrate first on the return. I want markets, I want to be able to outperform the market by picking stocks and picking futures markets that are going to do the best. All right, and then I'm going to worry about how do I reduce the risk. And it's not going to be by correlations. And in some of these cases, you're going to find that by selecting these stocks, I wind up with 50 or 60% of them in high tech stocks, which are the ones that are doing the best. So I may have NVIDIA and Amazon and Tesla all at the same time, which really wouldn't work if you're trying to reduce the correlations, but it really does work when you're trying to outperform the market. And these stocks have a way of persisting for periods of time. If you go back and you look at NVIDIA and you look at Amazon, you look at Apple, they persisted for a remarkably long time. So if I were to, you're probably familiar with the term, the fat tail. All these markets have a fat tail. I mean, they are, you would never imagine them continuing for so long, but they do. And that's how you make all the money. So the idea is to pick the stocks and pick the markets. All right, let me go on here. So can you have markets that have both high volatility and high returns? I'm sorry, low volatility and high returns. I can't even read my own writing. And yes, you do in periods when you have a very persistent market trend, like in the US stock market from 2010 to 2020. We had a tremendous bull market. And during that period, we have low volatility. And just as an aside, during these periods, you find that the volatility goes down. And if you're targeting a certain volatility, for example, you may want to have a 12% or 16%, which is one standard deviation of your returns. Say I use 20 days for that. You'll find that although you target a particular volatility of 10 or 20%, you find that the volatility drops to 8%. And when it drops to 8%, your returns go down at the same time. You can't do a lot in the stock market unless you add money to it. But in the futures market, because you keep reserves on hand, you can then increase your exposure to these markets to bring your volatility back from 6 or 8% back up to 12 or 16%, and that increases your returns. So you find that your returns are lower than you would like in markets that have low volatility. And as I said, you can't do much in the stock market, but you can definitely target volatility in the futures markets by manipulating the returns. And so when the volatility goes down, you add positions. When the volatility goes up, you reduce positions. Both of those are very important for maintaining your exposure and your risk control. And since I think most of you like to trade futures, you need to look into doing that in your system. You need to increase when volatility goes down, decrease when it goes up. And I usually use maybe 20%. I say if my volatility is 14% and it drops down by 20, which would make it closer to 12 or 11.5%, whatever it is, I then bring it back up to 14%. If it goes up by 20%, I bring it back down. And I find that really, really improves my percentage. Bringing it back up improves my percentage much more than bringing it down. When I bring it down, I'm reducing risk. When I bring it up, I'm increasing risk. And I'm returning my returns to what I had expected. Okay, we're worried now that I've gone off on a. Okay, this is the way I pick the right stocks and the right futures markets. Now I have to say that in the past, the big funds have counted on interest rates being the most likely candidate for big profits. Some funds have as much as 50% in interest rate futures because they have done so well over time, up to the last 2 years. The last 2 years have been horrible for interest rates. Now, in my systems, I only go long. I'm sorry, I only go short interest rates, long futures, short interest rates, because interest rates tend to spike up and then spend a long time coming down, much like the VIX spikes up, spends a long time coming down. So most of the money is made by being long futures in interest rates, short interest rates by themselves. But this has not been the market for it. What I do is I have a portfolio of, say, or I have a candidate list in stocks of, say, 500 stocks that are reasonably active. I don't want stocks that are not active. I like stocks that have volatility because that will give me good returns. So every day I run 500 stocks through my strategy. And let's say it's a trend following strategy. And I look at the most recent 3 months, 6 months. You have to decide that on yourselves. You don't look forever you don't look back 2 years or 5 years, because what you want to be able to do is pick the markets that are doing the best. So I only look at the recent market. So if a market had a terrible trend history, but now all of a sudden something's pretty good, I will pick that up in the profitability by looking at the last 3 or 6 months. And so what I do is I run all of my markets through my strategy. And then I look at the last 3 or 6 months and I rank them. And then I pick the best 10 stocks. And that way I'm guaranteed to pick stocks that are doing something important, that are making money on my system. By the way, I've tried this by just looking at the markets that have done the best overall performance. In other words, just the best returns without a system over the past 3 or 6 months, and they do terribly. You need a system to reduce the profits to something predictable. In trend following, I'm saying, okay, I want systems that have the best trend, not just the ones that jumped up, but the ones that have the best trends over the last 6 months, or whatever else fits a certain pattern, does, whatever pattern you're looking for. But I'll use trend following because it's the simplest approach. But anyway, you run it through your system, and then you rank them all according to the most profits. And it's only profits. It's not profits divided by risk or the Sharpe ratio, because the market doesn't want to be boxed in by that amount of analysis. We're going to treat the returns and the risk separately. So we want the markets that do the best returns, and we're going to pick the best 10 of those. All right. And in futures, we'll do much the same. But futures, we have some other considerations, and I'll talk about that in a minute. But in stocks, we do not look at what sectors they're in or anything. We only look at returns. So we will wind up heavily invested in tech stocks during those periods. Okay, so I may have already said this. The reason why we pick 3 or 6 months is if I pick longer periods and judge the profitability over system over 2 years or 5 years, I'll rarely get a change. I won't notice that a new stock has been good or that an old stock has become unstable. By looking at a shorter period of time, I get to look at how the system is doing in the shorter period, and that turns out to be very good. So I already said this on the bottom, that if I use things like the Sharpe ratio or how long it takes to recover or any of a million criteria for measuring risk, the system doesn't like it. It will not do anything. It's overfitting. And you think that doing two things like risk and reward would not be overfitting, but it really is. So take my word for it, profits are it. And so I sort them every day. And if a market falls out of the top 10, I replace it with a stock that goes in, that has moved up into the top 10. There are certain criteria. It has to have a position. I don't want a stock that's moved up into the top 10, but no longer has a position because its trend has failed, that it's no longer long. And so there are a couple of criteria to make sure that the top 10 all has positions. And if it falls, one thing you have to be aware of, that the one at the bottom that's just moved into the top 10 is going to be the one most likely to move out. So you have to allow the bottom one to move down a certain number of positions, 3 or 4 or 5, before it's being kicked out. Otherwise, you have the bottom one jumping in and out every day, and that's really bad for trading. So you have to give it a certain amount of latitude. Now, futures are a bit different. I've discussed stocks in this, and I trade both stocks and futures. Futures are a bit different. I mentioned that many of the hedge funds trade a large percentage of interest rates. Interest rates are highly correlated. U.S. interest rates are almost totally correlated. And in many cases, when the U.S. lowers rates, other places lower them too. Now, it's not happening right now. So you get a certain amount of correlation by trading European interest rates versus U.S. interest rates. But let me discuss this in theory when they were highly correlated. I look at the correlation in each sector so that we have the basic sectors in futures, which are interest rates and index markets and FX and metals and energy and agricultural markets. Of those, interest rates are by far the most correlated. And if you look at them, they're probably all close in the 90%. So sometimes if I'm ranking all of the index markets by who's doing better, and it turns out all the interest rates are the best ones, and I have nothing else because they're not performing well, I reduce my exposure by 50%. If I have two sectors, and those are the only ones that have markets that are good, I reduce by 20%. And if I have 3 or more sectors, I'm fine with it. So just so you know, I have to treat them a bit differently because the risk becomes unreasonable because we start out essentially with leverage of 20 to 1, and we reduce it with our reserves. But even at that, we couldn't have leverage of 4 to 1, 8 to 1. Is still a lot. So we have to be very careful with futures. So anyway, I realize now I didn't discuss some of the other issues. So let me just talk off the cuff about a couple of other issues that you need to reduce, need to consider. One is if your portfolio increases, looking at your portfolio, there's a certain point where your portfolio gets unreasonable. And it turns out to be the same point where volatility is unreasonable, which is 32.32 or 32%. So if volatility or VIX gets to 32%, most of the traders say the market's extremely volatile. What I do is I look at the standard deviation of my portfolio returns, not the VIX. And I say if the market, if my portfolio returns get above 32%, and that's using a 20-day annualized standard deviation, I actually get out of the market completely. I actually don't completely get out. I'm actually not quite the same. If the market is above 32%, but going in my favor, I stay with it because I can make a gigantic amount of money while it's very volatile, but going in my favor. But then I'm very careful about when it changes direction. So I'm monitoring it carefully. And then when it's above 30% and goes and starts, my equity starts down, I get out. So I have some latitude to stay with the market when it's doing very well. And then when it goes below 32%, and meanwhile, I'm monitoring my portfolio as though I'm actually trading it, and it starts to make money again, I then go back in. There's also another issue that I'm using lately, which is to track and this isn't for futures, I'm sorry, going back to stocks. I'm tracking the S&P because it's very hard to get um, to make profits when the market is dropping substantially, as it has been in the last few weeks. So you can use some trend of the S&P to decide that the market is highly correlated, and you can reduce your position size so that if you're using some long-term trend of the S&P and it shows you that the S&P has become or generated a sell signal from this, you can reduce your exposure by a certain amount. You'll have to test that yourself. I can't tell you how I'm using it, but the S&P is a good indication for when you want to reduce your exposure. So let's go through these things that I've talked about briefly. You need a strategy, and it could be as simple as trend following. You need to, I didn't discuss it, but you probably all know that you need to have each position that you trade be equal risk. So in futures, I use volatility parity, which is an equal investment divided by the dollar volatility of that particular stock. In stocks, I simply have an equal investment divided by the closing price. Not great, but okay. But you have to start out with equal risk in everything. Then I choose the markets that are best in my strategy, and I only use profits as a criteria. I then pick the top 10 stocks or 3 future sectors, if possible. I switch when the performance changes, which is why I use only 3 to 6 months as a criteria. And I exit completely when the volatility exceeds 32% and the price is no longer going up. Excuse me a moment. So now some philosophy. Just like the use of profits only, and when you test, remember the basic rules. The more rules you use, the less likely the system will work. You have to accept the fact that you're going to have risk. And that's why I suggest when you actually start trading your system, trade very small, but actually trade, because it's losing money that makes you a better trader. So you have to learn how to become familiar with losses and make it part of what you're doing. And as I say here, the fewer rules may look sloppy, but it's a better predictor of what will really happen in the market. Okay? Don't fiddle with the results. You know, you can make anything look good, but that won't turn the system into making money. The more you fiddle with it, the less chance it has of doing anything. A good friend of mine says, if you torture the data enough, it will tell you anything, but it won't actually help anything. I choose simple over complex. I don't like systems that are complex, because when something goes wrong with them, you really don't understand how to fix them. When you have a simple system, they do much better. And then when there's a problem, you can look and see, well, did I forget to include a certain amount of risk control? In other words, was there some other way of looking at risk that I could have done it? or did I need to change my performance criteria to be a little longer or a little shorter? But at least I'll understand what I need to do. If you do something very complex and something goes wrong, you'll have no idea which part went wrong. And probably it wasn't good to start with. So that's really all I have. I'm happy to take instructions, questions, I'm sorry. And as you know, a little promotional thing here. These are my latest books, if you have any interest. So I'm happy to take questions. I know I've jumped around a lot here. I hope you've learned something. You've learned certainly that I don't believe in diversification, if nothing else. So the topic of diversification was really a misnomer. Now, if anybody has questions on it, I'm happy to take them.
Okay, Perry, that's words of wisdom based on your experience. That's very good. I have one of your books. Well, I have several, but I have one that you
Oh,
have shown
good.
here.
Yes, that's a good one.
That's a good one. I can recommend it, yes. And now time for questions. You can put it on the chat or you just can open the microphone and ask directly to Perry the question. So go ahead. Don't be shy.
It's okay. It's not a problem. I know I've jumped around and
Good afternoon,
Jesus.
Perry.
Jesus
I have a few questions.
okay.
The first one is, do you trade options? Do you think they diversify with regular portfolios?
No, I trade multiple systems. My wife trades options. So so I don't have to worry about that. I have used options to protect profits. That's really
Hmm.
all I've done. I don't. Options are a specialty and require, from my point of view, special knowledge. And there's so much to learn in futures trading or trading in general that
Hmm.
I've just decided it's just too much. So no, I don't.
Okay. And about diversification, I agree with you that when it starts raining or it's a lot of crisis, you don't know, you don't have anywhere to hide. So
Yes, that's right.
that's mainly the effort of everyone to diversify. But when it's a crisis, all the people are hurt. So you told us that the main thing is to be out of the market.
It is. As I said, there are a few things. First of all,
Hmm.
when I sort these, stocks or futures markets, and I trade only the top 10,
Hmm.
even though I'm trading a trend following system, um, they shift around a lot. And while the trend may still be up, there may be better stocks or better futures markets that are doing better. And so
Hmm.
some of the some of the ones that have done well in the past drop out. So I don't have to wait for the trend to give me a sell signal
Hmm.
because they just drop out of the top 10. They may even be making money, but something else is doing even better. And and those markets replace the others. So in a
Hmm.
way, it's a way of reducing risk uh,
Okay.
without waiting for these markets to give you a sell signal in a long-term trend.
Hmm. So you change to a better to a better future or to a better
Yes,
asset, and
yes.
there you find that diversification or the thing that is today
No,
you will
I,
be long in gold, for example, if you're trading.
um, I don't really care about the diversification. I care about making money.
Okay,
Uh,
that's a good point.
and
That's a really good
and
point.
if like right now, because tech stocks have fallen off so much, I've been out of them for a long time. And the stocks that have surfaced are some in biotech, some in utilities, things that are less volatile. because those that a lot of markets have fallen by the wayside, and so they're no longer in the last 30 or 60 days, they're no longer good trend following stocks. So if you look at the stocks that have done well in the last 30 days, you'll find that none of them are tech stocks. So
Yes.
even though Apple has jumped up and Nvidia has jumped up in the last day or two because of what the administration said, they're no longer candidates. And some of the financial markets, some of the energy markets are the ones that have moved to the top. So anyway, so this sorting of 3 to 6 months of performance really is one of the major reasons the system can reduce risk. That and getting out of markets that are extremely volatile and watching the S&P trend are 3 big indicators of reducing risk.
Okay. The last question: Do you use a fundamental analysis to get out of the markets, or only technical analysis?
Everything I do is algorithmic. If I spent a considerable amount of time working on risk, and even though I could say to get out of the market 2 months ago because the U.S. administration had no idea what they were doing, I couldn't justify it unless I could do it with system trading. So everything I do has to be systematized.
Okay.
So, and it's a challenge.
Yes, of course. Thank you very much. I have a lot of your books, and I really enjoy your trading, your kind of trading.
Thank you.
God bless you.
Thank you.
There are some questions on the chat. Jose Borda said, the rule to exit was at 32% of volatility. It's only for stocks or futures too?
Yeah, I'm sorry, I missed that. I was thinking of something. Let me just mention to anybody that listens to this that if they have a question, they're welcome to use these my Gmail here to ask me a question. I'm very good at responding to questions.
Yes,
So,
he answers all the questions. No, it just said that the rule to exit was at 32% of volatility, that you said that.
32%
But this is only
plus.
for stocks or for futures too?
It depends on your portfolio. You see, the 32% was based on the returns of your portfolio. Not, I used it as a VIX example because they happen to use the same number, but it's really your portfolio. So if your portfolio using a 20-day annualized standard deviation exceeds 32% and the returns are going down, you get out. So if it's 32% and you're making money every day, you stay with it. So, but as soon as it stops making money, you need to get out and wait until the volatility falls below 32%. So I use the same criteria. It's a 2-step process. The volatility has to be above 32, plus you have to be losing money to get out. And on the downside, it has to fall below 32%, and your system has to be making money. So you don't want to get back in too soon. You don't want to get out too late, So it's a double process here.
Okay. Javier said, today you talked about applying same system to multiple assets. Do you think this is a superior approach to a portfolio of asset-specific systems?
I'm not sure I understood that exactly.
Yes, that it seems that you talk about applying the same system, a trend following system, to multiple assets, to multiple stocks or to multiple futures. and say that if you think this is superior approach to a portfolio of asset-specific systems that are adapted to each
Yeah,
asset.
let me mention this. I use this approach of sorting stocks, sorting the returns of various systems exactly the same way. I have 6 or 7 systems, and in futures and in stocks. And I do exactly this. I apply the same sorting principle using the performance of whatever the system is. And I apply the best stocks in those systems in the same way that I use trend following. I use trend following, but it could be a pattern recognition system. It could be I don't know, a timing system where you're looking for pullbacks in a stock or in a futures market. But I apply the same portfolio approach to every system that I use. Once I have the basic strategy, I then sort to find out which stocks, which futures markets are working best on that
Yes.
system. And then I pick the best ones. Because, not every system works for all markets. And so you have to be realistic that a particular system will do better on some markets and not others. And particular markets, a noisy market will be better with arbitrage. And so you have to select the markets that work best for your particular strategy, and running your system through a wide range of markets is the best way of telling. You throw away the markets that don't work, you trade the markets that do work.
Yes, that's very good. More questions. You have the opportunity to ask, Perry.
It's okay. So besides, this way I get to go have lunch.
Yes, it's time for going lunch in New York. Are you in
Yes,
New
it
York
is.
now?
What's that?
Are you in New York right
No,
now?
I'm in Chicago.
Are you in Chicago? Closer to the market, to the futures market.
Yes, we're used to trading futures here. So we let the New York people trade stocks. We trade futures. So, well, Eduardo, if there's nothing else,
There's
been
one more
great.
question, and this will be the last one.
Okay.
Saying, in the strategy evaluation process, do you follow a rigid methodical analysis process, or is it more open and creative?
Well, that could lead into another complete discussion. The way I test a stock, of course, I said that, you develop a system and you can run your stock or futures markets through it, which will indicate whether it works or not. But generally, I like markets that perform under a lot of different conditions. So I may optimize futures markets. You can't really optimize stocks. There are too many stocks. So if I'm looking for futures markets, I run different futures markets through my system, and I look at what you would think of as an optimization, which would be, a test of the trend from first, if it's a long-term trend, I'll start at 30 days to 120 days. And I'm looking for systems or for stocks that will make money in every one of those areas. In other words, I don't want a stock that makes money you know, in a trend from 30 to 50 days and loses money 60 to 80 days. I want a stock that has enough trend so that no matter which trend following I'm using, it chances are will make money. So what I do when I do optimizations is first I pick a period of time that I think are reasonable. As I said, for trend following, 30 or 40 to 120. And then I look at the average return over all those periods. I want the average return over all those tests to be positive. So I'm not looking for something that has a little spike of profit someplace and losses everywhere. I'm looking for markets that, or I'm looking for a system that will make money virtually no matter what time period I use. And then once I've done that, I then pick 3 periods in that optimization, like 30, 60, and 120. So I will trade 3 calculation periods within that optimization in order to get an average return. So when I look at the optimization, I'm looking for an average return over a test period. And then in order to get those average returns, I trade multiple periods within that. And I just net out those trades so that I will run the system for those 3 periods, look to see what the what trends I have during that, and I will trade the net of those 3 periods, so that in some cases they offset each other, in some cases they're all long or all short. But that's my approach to testing. You know, I want my system to be as robust as possible. And, you know, I'm not looking for a little period where it could make money. I'm looking for a period. I'm looking for markets that make money in general. I don't know if that answers the question.
Yes, I suppose so, because he said that you are a master of masters to me. Thank you for sharing your knowledge in your books. I'm deeply grateful, Perry. It's a pleasure for me today. So I
Oh,
think
thank you.
you have answered his question.
Okay.
And I think we are done. Thank you very much, Perry, for sharing your time with us and sharing all the knowledge that you have accumulated all these years in the
Yes.
markets. And it will be a
Well,
pleasure.
I'm sure your students will become good traders. So,
Thank you.
okay, Eduardo, I'm going to go have lunch now.
Thank you. Yes, it's time to have lunch for you. See
Okay,
you
bye.
another day.
Bye.
Thank you very much.
Okay.
Bye-bye.